September 23, 1998, 9 a.m., the New York Federal Reserve Building. William McDonough, president of the New York Fed, sat at the head of a conference table surrounded by the CEOs of every major Wall Street bank. Goldman Sachs, Morgan Stanley, Merrill Lynch, JP Morgan, all of them, and he told them something that made their blood run cold. Gentlemen, we have a situation. Long-term capital management is hours away from complete collapse. They control over $1 trillion in derivative positions. If they fail, the entire global financial system fails with them. You need to bail them out, today, or we all go down together. These men ran banks worth hundreds of billions. They competed viciously, hated each other. But in that moment they realized they had no choice. A hedge fund run by Nobel Prize winners and legendary traders had become so overleveraged, so reckless, that its failure would trigger a global depression. And the smartest people in finance never saw it coming. If you want to understand how the most brilliant minds on Wall Street almost destroyed capitalism and what their leverage mistakes can teach you about risk management, hit that subscribe button and smash that like button right now. Drop a comment telling me if you've ever used leverage to invest, because the LTCM story will show you exactly why intelligence and success are completely different things, and why leverage is financial dynamite that will eventually blow up no matter how smart you are. Let me introduce you to the Dream Team. 1994. John Meriwether, legendary bond trader from Salomon Brothers, decided to start a hedge fund, but not just any hedge fund, the most elite fund ever created. He recruited Myron, Scholes, and Robert Merton. Both would win the Nobel Prize in Economics in 1997 for their work on options pricing. He brought in David Mullins, former vice chairman of the Federal Reserve. He added Eric Rosenfeld, Victor Haghani, Larry Hillebrand, all PhDs, all quantitative geniuses, all the smartest traders from Salomon Brothers. This wasn't a hedge fund. This was an academic dream team that was going to use mathematics and computer models to print money with zero risk, or so they claimed. The pitch to investors was simple. We've discovered mathematical arbitrage opportunities in bond markets, tiny price discrepancies that our models can exploit. We'll make small profits on hundreds of trades simultaneously. It's low risk because we're just capturing pricing inefficiencies, not making directional bets, and because the profits per trade are small. We'll use leverage to amplify returns 25 to 1, sometimes 30 to 1. For every dollar of investor capital, we'll borrow $30 and deploy it. The math is perfect. The risk is minimal. Trust us, we're Nobel Prize winners, and people believed them. The minimum investment was $10 million. Only the ultra-wealthy could invest, and money poured in. By 1998, LTCM had $4.6 billion in investor capital and had borrowed over $125 billion to deploy in trades. Total positions, including derivatives, exceeded $1 trillion. That's not a typo, 1 trillion. And it was all controlled by about 16 people sitting in an office in Greenwich, Connecticut. For the first 3 years, it worked perfectly. 1995 LTCM returned 43%, 1996 returned 41%, 1997 returned 17%. Investors were ecstatic. Meriwether and his partners were paying themselves hundreds of millions in fees. They bought mansions, private jets, lived like royalty, and they truly believed they'd figured it out, that their mathematical models had eliminated risk, that they were smarter than the market. And that's where the arrogance began. By 1997, they were so confident they returned $2.7 billion to investors, not because investors wanted out, but because LTCM told them, we don't need your money anymore. We have too much capital and not enough opportunities. We're giving some back. Imagine being so arrogant you return billions to people begging to give you money. Then 1998 happened and everything fell apart in a way their models said was statistically impossible. It started in Asia. The Asian financial crisis spread to Russia on August 17, 1998. Russia defaulted on its government bonds, something LTCM's models said had essentially zero probability of happening, but it happened. And when Russia defaulted, global bond markets went insane. All the tiny price discrepancies that LTCM was exploiting suddenly became huge price dislocations, but they moved in the wrong direction. Every single trade LTCM had on started losing money simultaneously. Their models assumed different trades would move independently, that losses in one area would be offset by gains in another, but in a crisis everything correlates. All their trades lost money at once. Here's where the leverage killed them. Remember, they had $4.6 billion in capital and $125 billion in borrowed money. When their trades started losing money, they lost it on $125 billion, not $4.6 billion. In August 1998 alone, LTCM lost $1.9 billion, 44% of their entire capital in 1 month. Their lenders, the banks that had lent them the $125 billion, started calling asking for more collateral. Margin calls, just like 1929, but LTCM couldn't meet them. They didn't have liquid assets. All their money was tied up in illiquid bond positions they couldn't sell without taking massive losses. They were trapped. The genius model had become a death trap. By September 1998, LTCM's capital had dropped from $4.6 billion to $400 million. They'd lost 92% in 6 weeks. But here's the terrifying part. They still controlled over $1 trillion in derivative positions. They'd lost almost all their capital, but the leverage meant they still had massive positions open. And if they were forced to liquidate, to close all those positions at once, the selling pressure would crash bond markets globally. Their counterparties, the banks on the other side of their trades, would lose hundreds of billions. And because every major bank on Wall Street had exposure to LTCM, the entire system would collapse. Nobel Prize winners had created a financial doomsday device. That's why on September 23, 1998, the Federal Reserve organized the secret meeting. They forced 14 banks to contribute $3.6 billion to bail out LTCM, not to save the fund. It was already dead, but to prevent an orderly liquidation of the trillion-dollar position over several months instead of a catastrophic fire sale. The banks hated doing it. They lost billions bailing out their competitor, but they had no choice. LTCM was too interconnected to fail. Their collapse would have taken everyone down, and it was all because of leverage. Let me tell you about the human cost. John Meriwether, the founder, lost his entire personal fortune, estimated at $500 million, gone. The Nobel Prize winners Scholes and Merton, their reputations destroyed. Their life's work proving that brilliant theory doesn't survive real-world chaos. The investors, people who'd given LTCM 10 million minimums, lost 92% of their money. But the worst part, the arrogance. Right up until the end they believed they were right and the market was wrong. Meriwether later said we were correct in our analysis. We just got unlucky with Russia. No, you weren't unlucky. You were catastrophically over-leveraged. Here's what LTCM teaches about leverage. First, intelligence doesn't protect you from leverage risk. You can have Nobel Prizes, PhDs, decades of experience, the smartest models in the world, and leverage will still kill you. LTCM had literally the smartest people in finance. It didn't matter. Leverage has destroyed geniuses and idiots equally throughout history. Second, models are not reality. LTCM's models said a Russia default was virtually impossible. Their models said their different trades wouldn't correlate. Their models said they could always exit positions. All their models were wrong because models are based on historical data and history doesn't include the future crisis that kills you. Never trust a model that says risk is low. Third, when you use 30-to-1 leverage, you need to be right 97% of the time or you go bankrupt. LTCM was right for 3 years, made billions, then wrong for 6 weeks and lost everything. With extreme leverage, there's no room for error, no second chances. One bad bet and you're done. Would you drive a car where hitting one pothole explodes the engine? That's what 30-to-1 leverage is. Fourth, just because something worked historically doesn't mean it will work in a crisis. LTCM's arbitrage trades had worked for decades. Their models backtested perfectly. But in September 1998, when Russia defaulted and panic hit markets, historical relationships broke down. Correlations that were supposed to be 0.3 became 0.9, and their entire strategy failed simultaneously. And fifth, size becomes your enemy with leverage. LTCM controlled so much capital they couldn't exit. If they tried to sell their positions, the selling itself would crash prices further. They were trapped by their own size. This is the leverage paradox. It lets you get huge positions, but once you're huge you can't get out. You become the market instead of trading the market, and when the market turns against you, you die. So what are the safe leverage limits? Here's the rule. Never use more than 2-to-1 leverage in liquid markets, 1-to-1 in illiquid markets. That means for every dollar you have, borrow $1 more maximum. Even that's risky. LTCM used 30-to-1. That's suicide. Even 5-to-1 is extremely dangerous. 2-to-1 gives you room to be wrong and survive anything beyond that. And you're gambling your entire future on being right. If you found this valuable, smash that like button. Subscribe for more true stories about Wall Street disasters. And share this with anyone using leverage to trade or invest. Because LTCM proved that Nobel Prize winners using sophisticated mathematical models with 30-to-1 leverage almost destroyed global capitalism. Intelligence doesn't protect you from leverage risk. In fact, it makes you more dangerous because smart people convince themselves they've eliminated risk through complexity. They haven't. They've just hidden the risk until it explodes. Don't be a genius who goes bankrupt. Be a humble investor who survives. Avoid extreme leverage. Assume your models are wrong. And never believe you're too smart to fail. Because the smartest people on Wall Street believed that in 1998, and they lost everything in 4 months.